Folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond at the Contrarian Trader. And what we're going to do today is begin by talking about how we did last week in a very volatile market. How were we prepared for last week's trade when we went into what we expected to be a volatile session, meaning last week. And we'll leave off with the stocks, ETFs that we are looking to add to our portfolio potentially this coming week. So let's kick things off. How was our week last week in a very volatile session? It was pretty good because we were short. We were short of the S&P 500 here, and we sold the rally on Friday. Now, why did we sell? How do we know to get out? Because we were looking at the 2-hour chart. Now, in using the 2-hour chart, we got out just shy of the highs of the day. Why did we get out? It's because we had a lot of resistance above at the 2246 level. We had the declining 200-period moving average. And also, when you take a look at the weekly chart, the high of the day coincided with resistance on a weekly basis. So it was first out, best out. Now, do I like the SPXS, meaning being short of the S&P 500 into the next week or the following week? Yes, I do. But there are certain criteria that need to be met for us to want to get long yet again. And we'll discuss that with members tomorrow on the week ahead commentary, where we discuss our strategy session. So how did we know going into the week that we should be looking to the
30-year bond
short
price,
side
quarterly
of the market?
Going all the way
here's what
back
I had to say to members
78,
last
79.
week on
Folks,
the
we
week
broke
ahead
down
commentary with
last
regard
quarter.
to the
And I
bond
want you
market.
to put this in perspective. This is not a 15-minute chart, a 2-hour chart, an hourly chart, a daily chart, a weekly chart, a monthly chart. This is a quarterly chart, a very significant time frame, a snapshot in time. Last quarter, we broke down and closed below the lower band of support. And you may be saying, Bob, we did that back here in the January quarter. We did it again here in the April quarter. Yes, we did. But we rallied back and the lower band of support was respected. This time, it didn't happen. And we closed with a new lower low on the 30-year bond price. So what happens when the 30-year bond price goes down? Yields go up. We have broken down clearly on RSI, and we did so the prior quarter. This is a very weak chart. Things are, I shouldn't say are, they have the potential to become very, very scary, very, very quick. Once the genie is out of the bottle in terms of inflation. If the government's denying it, yet the bond market's saying, hey, you got to pay us more for these bonds, too much risk. That's a problem. And the Federal Reserve can control short-term interest rates. Far more difficult to go out longer term on the curve and try to control a 30-year yield. Very, very difficult. They think they have the power, and maybe they do for all I know. But what will it cost? The 10-year yield monthly chart, we came just shy of a new high versus the May high. And if we close out this month above 3.11, we're going up here to 3.75 in a heartbeat. RSI looks rock solid. Weekly chart, 10-year yield, bearish reversal bar last week, no clear breakout. So we may get another pullback this coming week on yields. But then, in all probability, that'll set us up for a breakout. The U.S. dollar, weekly chart. Now, fast forward to this week, we had a new quarterly bar open up, and we put in a new quarterly low. So we have a continuation breakdown on the 30-year bond price. What does that mean for yields? It means that they are shooting higher. Now, with regard to the 10-year yield, which I discussed, here's the weekly chart. And I wouldn't have been surprised had we had a quick pullback on the 10-year yield. We opened flat and we just shot up higher. Now, we are leaning into the third standard deviation Bollinger Band. So we're a bit extended here, but what a massive move. And to appreciate where we are relative to yields historically, you need to take a look at a monthly chart.
And here you have it. We are at highs not seen since May 2011. Now, why is this bearish for the market? Well, you need to keep in mind the stock market has rallied because yields have been kept artificially low for 10 years. And as yields rise, well, the borrowing costs for the stock market rise as well, and the stock market's already very expensive, so that will impact their earnings. Therefore, it will impact their price to earnings ratio. And I won't even get into the huge increase in the amount of interest the federal government needs to pay on our national debt. And we finance all that. That just gets added on to our deficit. Not the trade deficit, but the budget deficit. So this is a problem here. So as we proceed into the new trading week, we're looking to the short side. Now, I will say this, that historically, during a midterm election year, the month of October has returned 3.4% on the stock market, or the S&P 500, I should say, which is pretty good. Now, why does that happen? And how can that happen? All that need happen is Jay Powell come out and say, you know what? It's a question mark as to whether or not we'll be raising rates in December. All will be forgiven. We'll get a rally, and it'll probably take us through to the new year. After that, all bets are off. Let's get to the charts that we like for the coming week. The TBT, I spoke about this one last week. It skyrocketed higher this past week. We are trading above the third standard deviation Bollinger Band on a weekly basis. We will probably pause here, but I think that the path of least resistance remains to the upside. Members will talk strategy with regard to an entry point on the TBT tomorrow using the daily charts. If you're not currently a member, sign up now. The website is being redeveloped. Prices are going up, and as a part of our membership loyalty program, we do not raise dues on existing members, ever. The next chart that we're watching is Deutsche Bank. Now, Deutsche Bank I'm watching because it's the canary in the coal mine. Have you noticed that the banks have been very weak despite the fact that yields have been strong and the banks should be doing well? What gives? I think that part of the reason lies with Deutsche Bank. Deutsche Bank is a huge bank domiciled in Germany, probably the biggest bank in Europe. And certainly it has counterparty risk with every major money center bank in the world. And you can see that we are, again, retesting this key support level. We closed out the week down about a little over 2% at $11.12. If we break down to the single digits on Deutsche Bank, you can bet your bottom dollar the conversation is going to become who has counterparty risk to Deutsche Bank. And when you take a look at a weekly chart, this is why I am really bearish on it. We broke down last week below the lower band of this triangle formation. We did have a breakout 3 weeks ago, but that breakout failed. Very bearish stuff. This is a head fake or a bull trap or a breakout point failure. Call it cupcakes. It doesn't matter. What it means is that things are bad over at Deutsche Bank. Keep an eye on this chart. Very critical. Once we break support, folks, you don't want to see Deutsche Bank in the single digits. Facebook. Okay, before I get into my commentary and my rant with regard to Facebook and the abysmal management at this company, abysmal. Zuckerberg may be a genius, but he's a moron. Here's what I had to say back in August with regards to Facebook. To the next article. Facebook bans activist mommy Elizabeth Johnston, I never heard of this lady, as the purge of conservative accelerates. Now, I was going to ignore this until I saw that she has 600,000 followers. Think about that. Now, this comes on the heels of the Alex Jones banning only a couple of weeks ago. I've said it in the past, and I'll say it again. These companies, Facebook, Google, Twitter, are slicing their own throats. And all you need to do is take a look at
the charts. Weekly chart Facebook. All-time high, $218.62. We're down. We closed yesterday out, 172.62. And you may be saying, Bob, it's because of their earnings. What don't you get? Yeah, well, why was their earnings impacted? Their goal the prior quarter, after Zuckerberg got ripped in Congress, was to hire 10,000 more censors. How much do you think that cost? And you're seeing it reflected in their share price. Confidence is being eroded in these names. I wouldn't buy these shares.
All right, so at that point in time, it was around here, we were breaking down, we were consolidating a bit. There was a potential promise of a breakout above this upper band of resistance. It never was realized. We broke down below the lower band of support here the week of September the 10th. We attempted to rally back and recapture. That attempt failed miserably. Last week, we had a continuation breakdown, new weekly and monthly lows, bad stuff. Facebook is setting up as a very, very nice short. So members, we will be talking about Facebook and shorting it tomorrow on the week ahead commentary. Take note of volume last week, very high. I think Facebook goes lower from here. And note that we closed just off of the lows of the week. Bad stuff. Hawaiian Electric Industries. We broke out the week of September the 24th. We had a bullish key reversal last week after retesting the breakout point. I think that HE, Hawaiian Electric Industries, is moving higher. Volume was a bit light. So members, tomorrow we will talk about an entry point for Hawaiian Electric and where we would want to stop out. Stokes looking really, really good. And the last time I spoke about this stock was back here in July when we were forming a W formation, a higher low, double bottom setup on the Stokes. It broke out, off to the races, all good stuff, great consolidation. HE is in all probability moving higher. Members, more to come tomorrow. LABD, this is the leveraged ETF that puts you short of the biotechs. Now, we broke out the week of September the 10th, consolidated, retested the breakout point. Last week, we broke out. Stochastics putting in higher lows and higher highs. RSI, same deal here. Higher lows, higher highs. It broke out of this trading channel. We did close off the highs of the week. So members, tomorrow, look at this volume. Members, tomorrow on the week ahead commentary, we'll do a deep dive into the daily and potentially the intraday charts on the LABD and decide what is our best risk-reward entry point and where we would want to stop out of the trade. Now, we've already gone over the SPXS, but it's worth discussing the setup on a weekly basis. Members will talk more about, again, strategy on the week ahead commentary tomorrow. We have RSI not broken out yet, but very close. Stokes are clearly hooking up. We closed just off of resistance, but honestly, the fact that we could not close last week out above this resistance level was a bit of a concern for me. Volume was very good, exactly what you want to see, above average volume. Take note of Ultimate Oscillator, higher lows, higher highs, and we broke out last week. So the SPXS looking good into the next week and weeks. The TZA, we broke out the week of September the 24th. Last week, a continuation breakout. The small caps have been lagging the large caps. RSI has broken out. Stokes have broken out. All your momentum oscillators are moving up. Exactly what you want to see. Volume has been outstanding. We have institutional accumulation. Ultimate Oscillator, higher lows, and we have now broken out to new higher highs. So the TZA is looking very good. But I'm going to leave off with this, folks. Remember what I mentioned earlier, that historically during a midterm election year, October returns 3.4% on the S&P 500. So while the technicals look pretty horrible right now for the major averages, all that's required to get a short squeeze going into the holiday season when you have your typical Santa Claus rally is the Federal Reserve coming out with modified statements during their weekly speeches and giving hope to the markets that, you know what, maybe they're done raising interest rates for the short term. That'll put a bid under the market that will send shorts fleeing. So don't get overly zealous to the short side just yet. I think that opportunity will come as it did last year after the first of the year. Members, tomorrow we'll be talking about a strategy session going into next week, as well as talking about our positions, where the markets have been, where do I think that they're going. If you're not currently a member, sign up for the 14-day free trial offer. It's 2 weeks. Cancel at any time. And if you're not ready to join up yet, that's fine. If you watch us on Facebook, leave a comment, give me a like, share with a friend, click the bell icon, which is a notification icon that will let you know when I put out new commentary. If you watch us on the website, enter your email address, We Hate Spam Too, get a couple of free trade tutorials, and never miss one of my free commentaries. Everybody enjoy the remainder of your weekend. Members, again, I will speak with you tomorrow. Everybody have a great weekend and a profitable trading week. Be well.